The HMBS or HECM mortgage-backed security program came under scrutiny when Ginnie Mae had to assume the sizable portfolio of reverse mortgage funding or RMF's mortgage-backed securities, that following the company's bankruptcy. This ultimately led to the development of HMBS 2.0, which has been in the works for several months, in the hopes of launching the new program in 2025. Now, HMBS 2.0 is being embraced as a potential template for traditional mortgage-backed securities. A recent Housing Wire column notes, the Mortgage Bankers Association, the MBA, this week published a proposal for Ginnie Mae to develop a new mortgage securitization product that could boost the availability of private capital liquidity sources into the market, particularly in periods of stress for the U.S. economy. Importantly, the association said that the recent development of Ginnie Mae's new complementary home equity conversion mortgage or HECM-backed securities product, known as HMBS 2.0, could actually serve as a logistical template for such a product. When asked about the possibility of HMBS 2.0 serving as a template for the new EBO proposal, New View Advisors partner Joe Kelly said this to Housing Wire's Reverse Mortgage Daily, that they had touched on it in a recent blog post. It describes how the HMBS program has gone from a program to eliminate to a program to emulate. Unlike a typical Ginnie Mae security based on pools of insured or guaranteed residential mortgage loans, the Ginnie Mae early buyout or EBO security would not be based on a modified pass-through structure, the MBA said in their white paper that outlined the proposal. Instead, it would be similar to Ginnie Mae's HMBS FHA-insured reverse mortgage loans, where the investor is paid an accrued sum at the time that the loan resolves. The proposed product would expand liquidity for government servicing through all economic cycles, said the white paper, according to MBA President and CEO Bob Brooksmith. An EBO security addresses the timing mismatch within Ginnie Mae's program, helping to alleviate an ongoing issue that has concerned issuers and regulators alike. HMBS 2.0 is designed to enable the acquisition of loans from an HMBS pool above the existing 98% maximum claim amount of a HECM, and that would aim to address the liquidity challenges that plague the reverse mortgage business that stemmed from the late 2022 bankruptcy of reverse mortgage funding and the run-up in interest rates and also a precipitous drop in loan volume. MBA does detail some of their reasoning for looking to the existing HMBS program and HMBS 2.0 as potential paths for their proposal. Ginnie Mae has very recent precedent for guaranteeing securities without monthly cash flow and with uncertain duration, according to the white paper. Its HMBS program similarly provides issuers with the option to purchase HECM loans out of their origination pool and repool them into a new class of security, providing operating liquidity until the issuer has resolved any issue with the loan that prevents its assignability to FHA. Therefore, HMBS 2.0 could serve as something of an example for Ginnie Mae to observe when looking at new securitization products, can you believe it, for traditional mortgage loans. Following the Federal Reserve's 0.25% Fed funds rate cut last week, the National Association of Realtors chief economist posted this to LinkedIn. Despite the cuts to the short-term interest rates by the Federal Reserve, mortgage rates have largely refused to budge. One reason is that the consumer price inflation has not been fully contained and slightly accelerated in the past 2 months. Now, what Yoon is referring to is the PCE, or the Core Inflation Index, which the Fed watches closely when considering rate changes or policy changes. Now, the index was at an annual rate of 2.7% from July through September, but ticked up to 2.8% in October, according to the Bureau of Economic Analysis. Yoon explains why this is important. Lending money over the longer term needs to compensate for future returned money's loss of purchasing power. Very good point. While long-term interest rates may be stuck, at least for the time being, more Fed fund rate cuts are expected in 2025. In one forecast by Bright MLS, it is expected that the mortgage rates will stay above 6% throughout next year. So why does this even matter for reverse mortgage professionals, you may be asking? Because it reveals the macroeconomic forces at play in housing finance, to which, by the way, the HECM is not immune. The same forces that have pushed traditional 30-year mortgage rates higher are impacting the 10-year constant maturity treasury rate, or CMT, which in part helps determine a federally insured HECM reverse mortgage's available loan proceeds at closing. Statista.com notes the 10-year Treasury constant maturity rate in the U.S. is forecast to decline by 0.8% by 2026, while the 30-year fixed-rate mortgage is expected to fall by 1.6%. From 7% in the third quarter of 2023, the average 30-year mortgage rate is projected to reach 5.4% in 2026. It's not a big drop, but every little bit does help qualify more traditional and reverse mortgage applicants. Do you remember just how much your last vehicle cost you? Well, I certainly do. That's why I bought a used 2011 Ford F-150 for $19,000 in 2022, instead of spending $70,000 to $100,000 on a new truck. More than ever before, new car prices now rival what a modest home may have cost just a decade or more ago. Go Banking Rates addresses this challenge in a recent column, and it notes that Dave Ramsey says that monthly car payments are actually costing Americans millions of dollars, and what they can do instead with that money. Now, last week I beat up pretty hard on Ramsey's mischaracterization and falsehoods and outright ignorance about reverse mortgages, but to be fair, he may actually have a point. Now, according to the Federal Reserve Bank of New York, auto loans are now the second largest household debt in America, standing at $1.64 trillion, which is actually slightly higher than the student loan debt at $1.6 trillion. But it's still far behind mortgage debt balances, of course, which are $12.59 trillion. With a monthly average car payment being as high as $700 or averaging $500, used and leased vehicles respectively per lending tree, it really makes little sense to throw so much money or any money at all at a depreciating asset that's being financed and taking on more debt. Posting a short video blast on X, formerly Twitter, at the beginning of November, Ramsey emphatically stated his case, saying,
"And you scratch your head and wonder why you're freaking broke. Average car payment in America now is $499. That's suspiciously like $500. If you take $500 a month and invest it from age 30 to age 70, you'll have, would you believe it? You're going to have over $5 million.
Now, successful wealth builders, says Ramsey, do not put their money in Ford and Toyota's finance departments, and they certainly don't spend decades making payments on a succession of vehicles. Now, of course, for most, this is not possible. But indeed, they could instead grow their fortune by investing that money for the future. I would add there is an ideal world in which Americans don't have to sink themselves in the debt with expensive vehicles and forego the opportunity to invest and instead put that money to work to make potentially millions. But then there's the real world that we all see, where millions of older homeowners are in fact burdened by debt that has eroded their quality of life. Now, in such cases where their needs are outweighing the concerns of leaving an inheritance, a reverse mortgage could make sense. And that concludes this week's episode of HECMWorld Weekly. We want to express our wishes for a very safe and Merry Christmas, and we'll see you here next week for more reverse mortgage news you'll only find here at HECMWorld. Have a great week.